Hi, today we are continuing with our previous topics, admission of a partner, whereas in partners, admission of a partner we were doing new profit sharing ratio which carries you exam point of view 6 marks. Now, admission of a partner is nothing but when a partnership firm have more than 2 or more partners, ask one more person to join as a partner with admissed profit or loss to be shared to him. So in this question, it is a compulsory 12 marks in your state board as well as in preparatory. It is mandatory to learn the topics where based on this you are going to learn one more 12 markers, that is retirement of a partner. So let us concentrate what is this admission of a partner. A firm with more than 2 or more persons working as a partners in a firm admits new partner into the firm with a new profit sharing ratios. Okay, the new partner is going to bring capital as well as goodwill of the firm. So in these cases, as I told, it is a 12 marker question in a compulsory exams. You need to prepare 3 statement of accounts: revaluation accounts, partners capital account and balance sheet. So these 3 will carry 4 markers each to make it. And if your balance sheet of the last account, if it gets tallied, you are getting surely 12 marks with proper allocations. So let us see what is this revaluation of accounts. Revaluation of accounts is nothing but the accounts, the assets and liabilities has to be revalued before a new partner is coming to the business. So the company, the partnership firm has lot of assets such as plant and machinery, land and building, patents, furniture, stock, debtors, everything. And on the other hand, the external liabilities, what they have such as bills payable, bank overdraft, sundry creditors, outstanding expenses has to be revalued, and the revaluation may include increase or decrease. So the process of increase and decrease of assets and liabilities of the partnership firm has to be accounted in revaluation accounts. So this account is nothing but a ledger account, consists of debit, credit, particular amount, and the debit side consists of expenses and losses, and credit side consists of incomes and gains, that we will go through later. And nextly, partners capital account. It is nothing but the investment made by the partners in the account and the investments of a partners before joining the new partner and after joining the new partner. So there may be multiple items you are going to add it to the capital account of the partners, such as reserves earned by the firm, profit and loss earned in the previous years, profit and loss earned in the particular year, any loans or loans payable to the partners, drawings made by him, goodwill accumulated, and all these entries are before admission of a partner. Make sure not after admission of a partner. Next, the third and final account is balance sheet. As you are aware about it, balance sheet is a statement of assets and liabilities, and it provides you the financial structure of the company, where does the company stands. The liabilities of the company should be equal to the assets of the company as per the financial positions. Hopefully everybody understood. I repeat my words. The admission of a partner consists of 3 questions, 3 accounts: revaluation accounts, partners capital account and balance sheet. The difference between debit and credit will be the profit or loss of the business which you are accumulating from the revaluation accounts. If the credit side is more than the debit side, it is called revaluation profit, and if the debit side is less than the credit side, it is revaluation loss, which will be carried out to the partner's capital account with the loss or profit earned by the firm before admission of a partner. And next, the closing capital after all adjustments such as general reserve, profit and loss account, surplus, revaluation profits, drawings, goodwill, everything, that will be carried as a closing capital of the partners under the balance sheet under liabilities column, and balance sheet should get tallied with the value of the liability should be equal to the value of the assets. Okay, so each statement of account will carry 4 markers each. So the total should be 12 marks including your accounts format. Let us start with revaluation account. See, revaluation account format is similar to the ledger accounts, but we don't record any dates here. We are going to record only the particular amount and no dates clause mentioned here. Decrease in assets. It may be depreciation or sale of assets. So that will come under the decrease in assets. That will be a loss to the company. So we will record it under the depreciation under revaluation account. Loss on sale of assets too. So depreciation on fixed assets, decrease in the value of the stock, decrease in the value of the debtors, decrease in the value of the tangible and intangible assets, either in terms of depreciation or loss on sale of assets will come under the debit side because it is a loss and it is treated as an expenses of the firm. And second, increase in liabilities. Of course, if the creditors is owable, creditors is increased. So that is nothing but we need to pay them more. Loan raised. It may be bank loan taken again. It is increase in the liabilities. So that at some extent, whatever the increase in the liabilities, it will be again coming under the debit side. And now, credit side. Increase in the value of the assets. Like appreciation, many times it happens with land and building, plant and machinery, etc. And debtors way off is been done. And provision for bad debts has been revised. It is an income to the company. So when the income to the partnership firm, it will be recorded as increase in the assets. Value of the assets are increasing, it is a profit to the company before joining of a new partner, and then decrease in the liabilities. Some creditors will waive off their fees. Written off. Loans. Some loans were written off. So these kind of things will be called as an income to the firm, which is again decrease in the liabilities. And the total of the assets and debit should not be equal. If the credit side is more and the debit side is less, then you will call it as the difference amount as revaluation profit. And if your debit side is more and the credit side is less, then it's treated as revaluation loss, which is transferred to the other account called partners capital account. Basically, partners capital account is a nominal account which studies about inflow and outflow of the partners. We have assumed that there are three partners, namely A, B and C. So this partners capital account is also a ledger account. Again, I am specifying you that there is no date needed. It's because it's done when a new partner is joining to the firm during the end of the period or at the middle of the period. Okay. So start with these basic items. By balance, okay, by balance brought down. So this is nothing but the opening capital of the old partners. Remember, it's old partners capital has to be brought, and the old partners capital is mentioned in the balance sheet under the liabilities column. So the two old partners capital will be written in the partners capital account as by balance brought down. Got it? And next, reserves. Any reserves, general reserve, reserve funds, employees compensation reserves, any reserves made by the firm before a new partner is joined has to be taken over to the old partners. And please do remember that we are not going to pay anything to the new partner because he is joining on the same day. He is not entitled as per the Partnership Act 1932. Okay, so reserves will be again given to the old partners in the their old profit sharing ratios. It may be 1:1, 2:1, vice versa. And do remember, if the ratios are not mentioned in your sum, you should treat it as equal ratio, 1/2, 1/2, or 1/3, 1/3, 1/3, whatever it may be, vice versa. So it should be clear. If the ratios are not mentioned in the question, please do take it as an equal ratio, 1:1. And this reserve has to be given only to the old partner in their ratios. And this profit and loss account is nothing but the profit or surplus made by the firm before the admission of a new partner. So it may be of previous year or previous old years. So this old profit and loss or surplus has to be distributed to the old partners again in the profit sharing ratio or equal ratio, whatever it may be. Revaluation account. This account is nothing but what we did in the previous one, the profit and loss, what we get here by tallying the debit and credit side of that will be carried out to the partners in the revaluation account. And do remember, this profit earned in the revaluation of the assets and liabilities will again be distributed to the old partners in their profit sharing ratios, not to the new partner. And then this cash account. This cash account is nothing but the capital which new partner is bringing to the business, and it always be there in the first adjustment of your question. See, bringing the capital, some amount in cash or bank. So that we call it as by cash account. That is the capital of the C, which is a new partner. And goodwill. When a new partner is coming to the business, he is bringing the capital as well as a part of goodwill to the firm. And do remember that goodwill as an intangible asset, old partners are not using it for the business purpose and they are taking it into their account. So whatever the goodwill is brought by the new partner will be taken by the old partner in their profit sharing ratios. So here, capital, reserves, P&L account, revaluation account, profit and goodwill. All these 5 topics, I remember, I still again repeat you. Opening capital, reserves, profit and loss account, revaluation profits and goodwill of the new partner. All these 5 components has to be distributed to the old partners in their profit sharing ratio or equal ratio based on the questions. And on the other hand, we have to check about the expenses or losses as well. If your revaluation account has a profit, if it is profit, it will appear on the credit side, and if the revaluation account comes with loss, then it should come on the debit side. Again, it should be distributed to the old partners in their profit sharing ratios. This is nothing but old loss accrued by the firm. How do you identify whether this company is suffering from profit or loss? If that is a profit, it will be coming under the liabilities column of your old balance sheet, and if it is loss, it will appear on the asset side of the old balance sheet. So if the assets contains any profit and loss account in your old balance sheet, it is treated as a profit and loss account, and it has to be distributed to the old partners in their profit sharing ratios or equal ratio, whatever it may be. The total of the debit side and credit side should be checked, and the remaining is called as balance carried out to all the partners, and this we call them as closing capital value, which is transferred to balance sheet as their capital. Got it? So maximum of 5 entries and the maximum of 3 entries will be there in the debit side and credit sides. Opening capital of the old partners will be displayed as by balance brought down. Reserves accumulated by the firm will be taken by the old partners before admission of a new partner in their profit sharing ratios. Profit earned during the previous years, which is reflecting on the liability side of the old balance sheet, will be issued to the balance sheet in the old partners in their profit sharing ratios. Then the profit earned during the revaluation of the assets and liabilities will be transferred to the credit side of the old partners in their profit sharing ratios. the capital brought by the new partner will be appearing as a cash account in the partner's capital account in the credit side, and the goodwill brought by the old partner, as it is an intangible asset, it cannot be converted, will be taken out by the old partners in their old profit sharing ratios. Got it? So there are these items. On the other hand, if your revaluation of assets and liabilities comes with the loss, it should be displayed in the debit side as a loss, and it will be distributed to the old partners in their profit sharing ratios. Next, profit and loss account. If the firm is accumulated a loss and which is displayed in the balance sheet on the asset column, will be coming on the debit side, and it will be distributed to the old partners in their profit sharing ratios, and the remaining balance will be called as closing capital, which will reflect in the liabilities of the new balance sheet. Now, the last one, balance sheet. It is a statement of assets and liabilities, and which describes you the financial position of the firm. Do remember, the total of assets and the total of liabilities should be equal. If your assets and liabilities are getting tallied, you did for the particular sum. Let us have, you will be taking out from your previous balance sheet and putting the same items, like you may have creditors, which is a liable to pay, bills payable, and bank loan. Along with that, this capitals is nothing but it is a new capital brought forward from partner's capital account. I show you that it is available here. So this is what the balance sheet, closing capital. So this closing capital has to be brought to the balance sheet in that column which is here. Got it? This one. So this is the capitals of the existing old and new partners, which was brought forward from the partner's capital account. Now again adjustment to the adjustments. Fixed assets. You may have a lot of fixed assets there, plant and machinery, land and building, furniture, etc., etc. Make sure that when you are taking with the old balance sheet, check whether you have revalued that assets or not. If you have revalued it, and if the value is decreased, minus the value of the asset, and the value is increased, plus the value of the assets. Fixed assets, the existing present value. Current assets, which includes sundry debtors, bills receivable, inventory or stock, then cash in and cash at bank, and any prepaid expenses which we are coming in the adjustments or loss. And when you are done with it, make sure that all the adjustments are, with the adjustments may be 4 or 5, but whatever the adjustments are there, that should always be reflected in your balance sheet, including closing stock. If you are missing out any of the adjustment, your balance sheet it will not get tallied. Understood? So this is about the admission of a partner, which carries 12 markers, and make sure that it's very easy to do it with doing the 3 statements of accounts: revaluation account, partner's capital account, and balance sheet, which carries 12 marks. So in our next session, we will be doing practically solving out these 3 types of questions, which makes you more impressive and understand the concept very easily. In previous session, we were discussing about admission of a partnership firm, and I have told you about the preparation of the multiple accounts to make an admission of a new partner. There are 3 partnership accounts. One is revaluation account, partner's capital account, and balance sheet, and the things and the contents have already been told to you. So let us go with a practical sum now to check how can we do this sum. So I will read for your reference. A and B are the partners who are sharing the profit and losses in the ratio of 2:1. And for your fine reference, they are providing you the balance sheet of the company as on 31st March 2024. So the balance sheet structure is liabilities amount, assets amount. The liabilities of the partnership firm which was owned by A and B are, they add creditors with 20,000, bills payable 7,000, reserve fund 18,000, capital of A 60,000 and capital of B 40,000, which is amounting to 1,45,000. On the other hand, let us go with assets. Assets, we have a cash in hand with 8,000, stock 15,000, debtors 20,000, machinery 30,000, buildings worth 60,000, and they have an investments for 12,000. So the total of assets again will be 1,45,000. So the balance sheet of the A and B partnership firm is tallying with 1,45,000 on the both the side assets and liabilities. Let us go with the adjustments what they have now. On 1st January 2024, they admits partner name called C into the firm on the following conditions. So let us go with the conditions because these conditions are very much important while doing the following revaluation, partnership capital and balance sheet after the admission of a partner. So he has to bring 25,000 in cash as capital and 15,000 as goodwill in cash towards his profit ratio of 1/5. So that means he is eligible to get 1/5 of this new share. So what is the ratio of the old partners A and B? It was in the question 2:1. That means 2/3, 1/3. Okay. Next, second adjustment. Usually when a partner is coming to the business, the partnership firm of the old partners will revalue the assets and liabilities. So after the revaluation of the assets and liabilities, it was found that building was appreciated by 20% of their value. Please do remember that appreciation is always an income to us. Next, stock was revalued at 12,000. Let us see, whatever the old value, it is revalued to the 12,000. So the stock was 15,000, now it is revalued to 12,000. So there is the stock is reduced by 3,000. Next, maintain provision for doubtful debts at 5% on debtors. So provision for doubtful debts is nothing but the debtors has an unrealizable value of 5%. And it was also found in the last adjustment that they have an outstanding salary which is not paid at 2,000. So it is a liability, current liability which has to be paid after the joining of a partner C. So the question is very simple. They have 5 adjustments. The first adjustment is C is bringing 25,000 in cash as a capital and 15,000 as goodwill in cash to his 1/5 of ratio. Second one, building is appreciated by 20%. Third one, stock is valued for 12,000. Fourth one is maintain provision for doubtful debts at 5% on debtors, and there is an outstanding salary of 2,000 which is to be paid as a liability. So now they request you to prepare revaluation account, partners capital account and balance sheet. So this was the question for which we are going to do now the 3 accounts, revaluation account, partners capital account and balance sheet. And do remember that this will carry you a 12 marks question, and if the balance sheet is correct, you will get out of out. Okay, start with revaluation account. As I told, if the value of the assets and liabilities are revalued, and if the assets value is increased, it will be an income credit side, and if the assets are reduced, it will be on the debit side. So let us go with the first adjustment. So this is that appreciate building by 20%. So the building value was 60,000, which was 20% increase, it's a profit. So by building 60,000 into 20% is the hike. So 20% will come to 12,000. Building is increased by 20%. So the value of the building was 60,000 and it is increased by 20%. So we have an increase of 12,000. On the other hand, the second adjustment says that the stock was revalued for 12,000. The old stock was 15. It was revalued to 12. So there is a decrease in the value of the stock from 15,000 to 12,000. So we have a loss of 3,000. Is it correct? So stock is reduced. Next, we have to maintain PDD on debtors and they said it to maintain 5%. What is the value of the debtors? The debtors value was 20,000. So what is 20,000 into 5%? It is 1,000. And lastly, we have an outstanding salary of 2,000 which has to be paid. So as the salary comes under the expenses and liabilities, it has to be posted in the debit side. Outstanding salary 2,000. So we have come up with all the adjustments. Increase in the value of the building, decrease in the value of the stock, decrease in the value of the debtors, and there is an expenses. So when we total it, the credit side has more value than debit side. So to equalize, 12,000 is the total of the debit and credit side. On the other hand, we have only 3 plus 4 plus 2, 6,000. So the remaining is my profit. Profit to partners capital account, and this will come 6,000. So revaluation account clearly told that the firm has an profit of 6,000 which is to be transferred to the old partners. Based on that, building was revalued for 20% increase, stock was decreased by 3,000, there was a provision for doubtful debts made for 5% on the debtors, that is 5% into 20,000, that is 1,000 rupees, and there is an outstanding salary which has to be payable 2,000. So this 6,000 whatever is there in the partners capital account has to be transferred to the partners capital account. So the first step is over with we have earned 6,000 as a profit. Let us move to partners capital account. So we have a partner called A and B as a old partners, and C is coming down with the new partner. So the old ratio of the partners A and B is 2:1, that is 2/3 and 1/3, and C is coming with 1/5. Okay, do remember. Now let us start with the capital of the old partners. The old partners capital which was there in the balance sheet was 60,000 and 40,000. C does not have anything. 60,000 and 40,000, and then we have a reserves. As I told you in the previous session that all the reserves, profit and loss account and revaluation profits, goodwill has to be distributed to the old partners in the ratio of 2:1. Right? So reserve, it is found that it is 18,000. We are going to distribute it to the old partners in the ratio of 2:1. That means 2/3, 1/3, which amounts to 12,000 and 6,000. And we have a revaluation profit which was carried out from that account. I'll show you where did we got it. See, this 6,000. This 6,000 has to be carried to the partner's capital account. So 6,000 in 2:1, it will come around 4,000 and 2,000. And we didn't found any profit and loss account or any other adjustments. We are directly going now with the new partner who is coming down with the cash. That is in the first adjustment. C brings with cash of 25,000 as a share of capital. And also he brings 15,000 as his goodwill. So that has to be again given to A and B in the ratio of 2:1, which amounts to 10,000 and 5,000. I do repeat my words. Capital, reserves, revaluation profit, profit and loss account, and goodwill of the former, goodwill of the old new partner has to be distributed only to the old partner in their profit sharing ratios. We have done with it. So now the time to add up all the components. A 60, 72, 76, 86,000. Then B 46, 48, 53,000. and C goes with only 25,000. So there is no drawings, there is no loss or anything in this business. It has to be transferred simultaneously with 86, 53 and 25. So this will become to balance carried down. So where it is going? It is going to balance sheet. The same 86, 53 and 25. So we have done the partnership capital account with their capital of the old partner A, who has invested 60,000 and B has invested 40,000, and the reserve of the firm was valued for 18,000, which has to be distributed in 2:1, which we did 2/3 and 1/3. Then we have got a revaluation profit of 6,000 from our previous account, which is again we are transferred in 2/3 and 1/3, that is 4,000 and 2,000. C is bringing his capital in cash for 25,000, which we have recorded here, and he is bringing 15,000 as goodwill, which we are going to distribute in the 2:1, that is 2/3, 1/3, amount of 10,000, 5,000. The total of A, it is nothing but the closing capital of the A, 86,000, B, 53,000 and C, 25,000. On the other hand, if you come to the debit side of the partner's capital account, if we have drawings or do we have profit and loss account or any other interest on drawings has to be calculated. As there is no such in my questions, I am directly transferring all these balances to 86,000, 53,000 and there 23,000. So these two balances carried on has to go to the balance sheet. So balance sheet is nothing but the statement of profit and loss, which gives you the financial position of the firm, which we are going to do now. Do remember, if our balance sheet gets tallied, we are getting our maximum marks. So nothing to do with balance sheet now. Go with the existing old balance sheet before admission of the C. We found that there was a creditors which we did anything. So we haven't touched that. So we have to write it as it is with the value of 20,000. And we have bills payable of 7,000. Do remember, I am transferring the components of the old balance sheet to the new balance sheet with the amendment. Next, I have a capital of A, B and C. So what is the capital of the A and B and C? I have to check. So A capital, B capital, C capital is here. See, this is A capital, B capital and C capital. The closing balance of the partner's capital account will be the capital of the A, B and C, which I am writing it down. So A stands for 86,000, B as 53,000 and C as 25,000. On the other hand, let us start with the assets. Assets, do we have stock? Stock, it was 15,000 and we have reduced the value of 3,000, so it became 12,000. Next, debtors. The value of debtors was 20,000, and do you remember we have made a 5% PDD on debtors, so it will be 1,000, which we are going to remove it. So 20,000 minus PDD 1,000, you are getting 19,000. After the debtors, we have machinery. So the machinery was valued for the same value and there is no changes there. So it is 30,000. Buildings. Building was appreciated by 20%. The value of the building was 60 and we are appreciated by 20% with 12,000. It became 72. After the building, investments. So we have not found any changes in the adjustments, and the old value of 12,000 will be wrote as it is. Next, cash in hand. The cash in hand clearly says that it was 8,000 in the balance sheet which we add. Now check how much C brought it in the first adjustment. See, it was clearly told that C has brought 25,000 as capital in cash and 15,000 goodwill in cash. We have 8 with us. C is bringing 25 with us as a capital and 15 as a goodwill in cash. So all the together 15, 40, 48. Done with it. So we have posted the balance sheet items of the old balance sheet with some changes whatever we made. And when coming to the point of the adjustments, C brings 25,000 which we have posted, goodwill 15,000 we have posted, appreciate building we have appreciated, stock is depreciated with 3,000, PDD made for 1,000 and lost outstanding salary payable 2,000. So outstanding salary which is payable 2,000 is nothing but our liability. We have to repay it, which we will record in the liabilities column. Outstanding salary, it was 2,000. We have to add and check whether the total is tallied or not. 20, 106, 113, 166, 171, 181, 191, 1,93,000. Let us see with the asset side. 48, 58, 60, 132, 162, 193, 193. So we have got our balance sheet tallied. Let us explain once again. Creditors, the old value 20,000 has been brought back again with no changes. Bills payable, no changes, we have just carried out. And these are the things, assets. These are the assets which we carried from the partner's capital account. And when we come to the stock point, the stock value was 15,000 and there is a depreciation and the value was decreased by 3,000. We made it 12,000. Debtors value was 12 and we made a provision for doubtful debts at 5% on debtors, which was amounting to 1,000 rupees, and we have revalued for 19,000. Machinery, no changes in that. We are directly writing as it is with the 30,000. Buildings, it was 60,000 and we have appreciated by 20%. 60,000 plus 20% is amounting to 17,000. Investments, no changes we made as there is no such adjustments. 12. Finally, cash in hand. We had 8,000 with us and C brought 25 as capital and 50,000 we had with C by goodwill. So it is amounting to 48,000. Finally, the total of the balance sheet came from 1,45,000 to 1,93,000 after the admission of a C. See, the balance sheet of the old firm before joining admission of a partner was 1,45,000. I will repeat, see, there is no changes. I carried the same value. I changed the same value and reserve fund has been transferred to partnership firm. So it is not going to be posted because it is transferred to the old partners in the ratio of 2:1. And these capitals are again going back with that, where A's capital was from 60,000 it became 86 and B's capital was 40,000 became 53. On the other hand, cash in hand with 8 we have added more 40,000 because C has brought 25,000 in the capital and 15,000 as a goodwill. Stock, it was 15,000 and there is a reduce in the value for 3,000. Debtors, 5% is decreased towards PDD and machinery no changes. Building was increased by 20% because it was appreciated, and there was no changes in the investments. Hopefully the same thing what we did here has been transferred to the old balance sheet to the new balance sheet. So the finally conclusion, the balance sheet total of 1,45,000 was converted into 1,93,000 after the admission of a C. Got it? Thank you.